I'm Jared Pratt, CEO of Granite Peak Associates.
I'm Heather Piazza, Tax Manager at Granite Peak.
So we're always looking to highlight case studies, real situations that clients have done that save them a ton of tax money. And one that comes to mind recently, and it happens a lot in the veterinary space because most times you have the owner buying the practice or starting the practice, buying the related real estate. So the big topic for today here is what's a cost segregation study? How does that fold into tax planning, and what can it do to a buyer of real estate?
Cost segregation is used when you're either buying the real estate or you're renovating a building or a space for the practice. Now, you typically have an independent third party come in and actually perform the study for you. And what they do essentially is put a dollar amount to every single thing in the building. So whether it's the walls, the doors, the windows, the floors, the furniture, and what am I trying to say?
Not that. It's everything. It's everything. So you're breaking down the door handles and door knobs to its finest components. Instead of just calling it a blanket building, with buildings, IRS requires you to depreciate that property over 39-year useful life. You and I, we don't want to wait 39 years to recover that cost. So you have that cost seg company come in, they break it down, and then what can we do with that information?
Yeah, so once they put it into buckets, so they'll break down all of those items into 5-year property, 7-year property, 15-year property, and then ultimately some 39-year property. What that allows us to do as your CPAs is accelerate those depreciation deductions in the current year. So whether it be taking Section 179 on some of the items or taking bonus depreciation to accelerate those deductions and have tax savings in year 1 and then in the future years as well. Also, if you come in and your HVAC system breaks, what's the benefit of that?
Yeah, it's going to again allow us to fully depreciate, meaning a big expense immediately on either an old asset or a new asset, and then avoid having to take that big ticket item and stretch that depreciation expense, the cost recovery, what you get to take as a tax deduction over a much longer period of time. So generally what we're hearing and seeing is if you go through the analysis of going through with a cost segregation study, they usually return about 20 to 30% of your purchase price as year 1 deductible expense. So that could equate to big dollars, big tax savings in years 1, 2, and 3 of practice ownership. It's our job to keep as much money in your pocket day 1 as possible. Let's kick that tax can down the road so that you've had the years of service, you've had 3 years of working capital to build up the coffins a little bit, and then we can worry about taxes in years 3 and beyond.
So essentially what this cost segregation does is it accelerates deductions that you typically would take over 39-year life and allows us as your CPAs to take the deductions in year 1, 2, and 3 to accelerate them today's dollars versus wait the whole time to get those deductions.